Hey everyone, I'm excited to be talking to John Spitz today. He's the head of capital formation at Lightstone Direct, leading fundraising and business development for the firm's real estate investment platform. He has over a decade of experience in private real estate, partnering with family offices, high net worth individuals to provide access to institutional real estate strategies. We're going to be talking about all of these things today. And before joining Lightstone, he served as assistant vice president at Origin Investments, which some of you might have heard about, where he really expanded the distribution there, as well as his whole investor network. That's where he steps in today. He was here at PIMD Con. For many of you who are there, got to meet him in person. It's this fantastic group that we want to talk about today, get to know them a little better. And we're going to be talking about the current market. We're going to be talking about different opportunities that are out there in today's market, how to move forward with these, and just even some potential ways to get involved with them. So John, how you doing?
Hey, Peter, doing well. Thanks for having me.
I'm excited to talk to you, but I want to talk to you about a little bit about your background. Like, how did you end up in terms of your journey? Like, I know that you started like banking in Chicago. How did you end up from there to Lightstone? Like, tell me a little bit about this journey.
So, I got started in the real estate business really coming out of the Great Recession in around 2012 in real estate brokerage for the firm called Marcus & Millichap. And that was really my first exposure to the commercial real estate market. Fast forward a few years, I moved to Chicago, cut my teeth in commercial real estate finance. I was financing everything from spec single family homes to infill, multifamily, and condo development throughout the city. And then I went back to grad school while I was a lender. I went to DePaul University and pursued my MBA. And during that time, I met the co-founder and co-CEO at Origin, Mike Luckescope. And, it was a firm they had actually come and spoken to our institutional real estate class. And that was really getting my first exposure to the principal side of the business, the private equity real estate side. Had a conversation with Michael, joined Origin in March of 2020. And over the next several years, I worked on the investor relations side, focused on capital raising, working with individual investors, a lot of physicians, family offices, registered investment advisor, and really just learned the business over the course of that my 5-year journey there. And, lived through what was the kind of the crazy manic phase of the real estate market in 2020, 2021, and 2022. And then really the subsequent downturn really that we've experienced in private real estate over the last several years. Really, not too long ago, Greg Fink, who's our head of multifamily real estate at Lightstone, reached out and told me what they were working on and what we're working on here at the firm. And the opportunity was just so unique because Lightstone, we're actually one of the largest privately held real estate companies in the country. We've been around since 1986, and we invest across a number of different verticals. We invest across multifamily, industrial. We have a life sciences business. We've done a unique joint venture structure with Marriott Hotels. We actually helped create the Moxie Hotel brand, which maybe people that are listening to this have stayed in at some point. I know I did before I joined Lightstone. And it was weird because, at the time I hadn't heard of Lightstone. And the reason why was, over the course of that 40-year time period, most of Lightstone's investment activity was done using Lightstone's own capital. So, we actually raised some non-traded REITs back in the early 2000s, and we've done some institutional capital. We've raised some institutional capital rather, but we really have that really, I would say of our 12 billion, less than 10% of the capital that under our assets under management is with outside investors, which is again, very unique. And really, when Greg and I first spoke, what he mentioned was, when you looked at 2022 and 2023, I think we've all heard the stories of managers that got over levered or, bought deals using poor capital structures in 2020, 2021, and 2022. And as a lot of these managers started to blow up and some lost investor capital or just weren't making distributions as promised, when we really peeled back the onion, or when Greg and Soren at Lightstone, when we started peeling back the onion, what we noticed was that, again, just like it really came down oftentimes to really just poor incentives. And that's when they decided, okay, I think we can actually do this better, right? We can provide better real estate offerings with better incentives directly to individual investors. And that's when I left Origin and decided to come help build this platform at Lightstone.
Yeah, I think it's really exciting what you guys are building. I mean, again, I've I had heard of Lightstone before, but in much different context. And again, usually I felt like access to something like Lightstone was really just reserved for, institutional partners and things like that at a different level, and maybe not the physician investor. And so it's just a great opportunity to just get to know you guys and connect with you guys. I have a question for you. So, with Lightstone having been around for 40 years and again, involved in all sorts of asset classes right now, and you had mentioned multifamily, industrial, hospitality, all of these things, like what's the talk in there right now in the company business overall about the real estate market? I think that's what a lot of people are interested in. Obviously, there's been tons of talk about inflation, interest rates, supply issues. Again, like you mentioned, like certain multifamily operators having issues with debt and leverage and things like that. So what's the overall sentiment like from your standpoint, and what are you guys talking about internally about the market?
Well, I think that the conversation internally is, and I think this has been the conversation a while across the broader market is, you saw interest rates explode 300, 400, 500 basis points coming out of 2022. And you heard, again, really isolated incidents of properties becoming distressed, especially when we look at multifamily or we look at industrial, you've had really this very wide bid-ask spread because lenders have been much more patient during this past downturn to work with owners and to work with, and you may hear this term a lot in real estate or any publication, this term extend and pretend. And what that means for those that don't know is if I'm an owner and let's say I own a multifamily property and I have a mortgage that's getting ready to come due, even if like what's happening right now is that a lot of the deals, a lot of properties that were acquired during the 2020, 2022 run up, the property values have gone down since that time. But property level fundamentals, meaning the properties are still cash flowing, so they still produce sufficient cash flow, but the property values have gone down because interest rates have risen. And so what a lot of lenders are doing is because most of these owners are still able to make payments, what they're doing is extending those loans, hoping the valuations will rebound in maybe 1, 2, 3, 4 years. And so that's the term extend and pretend. And so we've seen that. And so finding attractive acquisitions right now has been challenging, especially in multifamily. The hotel business is kind of its own thing. In fact, what we're seeing right now across our hotel portfolio, because there hasn't been a lot of supply right now. I don't know if you, Peter, or anyone else on the call has tried to go on vacation recently or booked a hotel recently, but room rates almost across the board. I mean, what we're seeing specifically in New York City and places like Miami, New York City, and Los Angeles is room rates have absolutely exploded because there just hasn't been any supply there right now. And so our hotels are doing great. I would say that that's the fundamental, kind of taking a step back. What we're really seeing right now is it being very selective across different verticals is how we're operating right now, as opposed to, just buying, as opposed to a much broader opportunity set where there's just acquisitions, an abundance of acquisitions. That's just not really what we're seeing right now. So again, to kind of be more succinct, I would say just being selective across a number of different asset classes is what we're doing right now.
I guess just a broader sentiment. Are you guys optimistic about where things are going to go in the next 3 to 5 years?
Yeah, I think so. And really what I would say in general, what we feel like right now is that valuations have largely reset. So when we look specifically where we're looking at right now is multifamily industrial, like in terms of investment opportunities. We are also looking some in the life sciences space, which is pretty unique and has some distressed elements to it. But what we're seeing right now when we think about multifamily and industrial more specifically is that you've seen valuations reset anywhere between 20 and 30%. The interest rate picture looks more clear. Now, again, we're generally not making investment decisions that, we think interest rates are going to decrease. Like we're never underwriting based off of what interest rates are doing. But more importantly, so you have valuations that have reset and we have a much more favorable supply demand picture. So just to back up for a second, what happened during COVID, because you had a zero interest rate policy, was there was a flurry of development activity across most verticals, really, except with the exception of hotels to a certain extent. But life sciences, multifamily, and industrial, Class A multifamily industrial and life sciences buildings were getting developed really across the country, but more specifically in the Sun Belt. As a result of that, in 2023 and 2024, we saw a significant amount of new deliveries. And in fact, the apartment market saw a 40-year high in new apartment supply. And again, 70% of those deliveries happened throughout Sun Belt markets. But what we've still seen, though, is we've seen very strong absorption for the most part, right? And as we look at
explain what absorption is for people.
Yeah, absorption just means that it's basically just, it's a measurement of demand. So we have all of these new apartment deliveries that have come on in a lot of these markets, but they're all getting leased. All of the new apartments are getting leased. So what a lot of people expected was when you hear a 40-year high in new apartment supply, I know the first thing I thought was, okay, so rents are just going to absolutely plummet. And they have in certain markets where the supply has been way in excess of demand in markets like Austin, Texas, parts of Arizona. Boise, Idaho is a great example of where you saw rents fall 10, 15%. But for the most part, rents have been flat, which is unique. And in fact, in certain markets, a lot of these markets, you're actually starting to see rents rise again, although slowly but surely. For the most part, they've been roughly flat. But now as we look ahead, because interest rates have been higher and it's just been a more challenging capital markets environment, you have really no new shovels going into the ground for multifamily or industrial. So candidly, as we look ahead, whether you're doing development or whether you're buying existing assets, we think the opportunity set looks far more compelling over the next 3 to 5 years. Again, these things don't happen overnight, though. And I think that's something that we have when we're talking to investors, especially when they look at the S&P 500 and what that's done over the last several years. This will be a slow recovery. We're definitely in the first inning of this real estate market recovery. But again, if you think about all of the challenges that hurt the market over the last several years, higher interest rates and a lot of supply, those things are in the rearview mirror.
Hey everyone, I have a question for you. What if there was a way to make your money work for you instead of the other way around? Let me ask you, are you looking for a way to create passive income and secure your financial future? Or maybe you've stayed away from real estate because you don't have time to be a landlord. Then I want to introduce you to Passive Real Estate Academy. It's the revolutionary platform that we created that teaches you how to invest in real estate passively with little or no effort on your part. In just 4 weeks, our comprehensive course will teach you everything you need to know about passive real estate investing and help build that confidence in you so that you know that you're making a great investment choice. We created this course for busy people like you, and we're going to guide you from every step of the way, from understanding even the most basic information to understanding the jargon and understanding underwriting so you can make sure that you're making a great investment, that you're maximizing your returns and minimizing your mistakes. And the best part, you can do this all from the comfort of your own home with absolutely no prior experience required. So it's time to prepare yourself and learn so that you can be ready for these deals that you see, because the time is coming. So don't let the demands of your job or the current economic climate dictate your financial future. So join Passive Real Estate Academy and build that confidence to know that you're making a great investment when it comes to syndications and funds. So visit our website at passiverealestateacademy.com to learn more and take your next step to financial freedom. Now back to the show.
I mean, when you guys think about real estate, though, again, what we try to say in our community is don't think about this as like a quick in and out. Like, think about real estate as like a long-term vehicle to create wealth, and know that there are these market cycles which aren't like on and off, and you've got to ride through these things. How do you guys think about it when you guys talk to investors? When you talk about like time horizons, when you set expectations for people in terms of investing in real estate, like how should people be thinking about this?
So when people are thinking about like investment horizons or time horizons, I mean, when we're setting expectations on front, the first thing is liquidity, right? So I think the biggest difference in our strategy. So at Lightstone, we build, buy, and own, right? So we have developed and we acquire real estate. Right now in this specific market cycle, we're very much in we want to be buying existing assets category, right? And so when we're setting expectations for investors, the one thing that we think about from an underwriting perspective is we want to make deals that produce strong cash flow day one, because we don't know what the market is going to look like next year, 2 years, 3 years from now, right? We can make assessments for all the reasons we just said, and we could talk about maybe some of the other tailwinds that are behind that. But I think we start with more of a top-down view. I'll just give industrial as an example. So industrial is really one of our more high conviction opportunities right now. So we start when we're setting expectations of what's going to perform not over the next quarter, but what's going to perform over the next decade. So why do we think industrial is going to continue to perform? Why do we think this is a secular bull market? One is obviously e-commerce is going to continue to be a big part of the story. Now, while some people think that this is an industry that has matured, and it has in many ways, like we're not expecting 30% compounded annual growth across the industry like you've seen from, let's say, 2000 to 2020 or 2021. That being said, as we all know as consumers, delivery times have tightened. What used to be with Amazon, you'd get a 2-day delivery, became 1-day delivery, and then same-day delivery. What's important is that there are massive implications across the industrial sector for businesses to hit that time frame, right? And as an investor in industrial, like Lightstone is, that is going to be a tailwind for us.
Industrial in your world, does that typically just mean warehouses? Just so people.
Correct. Yes, okay. Correct. Yeah. So you can break it out between warehouses or manufacturing facilities. We tend to focus more on warehouses that have multiple uses. So whether it's distribution, storage, parts assembly facility. So businesses that both serve the local economy, maybe service local manufacturing hubs, or do regional last mile distribution. So multi-purpose type of distribution hubs.
I mean, I don't know if people out there are hearing this and they're probably seeing, I don't know, in our area of town, we're seeing these things pop up left and right.
Right, exactly.
Like you're driving on the freeway for a while, and it used to be empty, and now you see this like humongous warehouse there. So I'm assuming those are a lot of them are like Amazon or delivery or distribution type services like you're mentioning. So that's what I'm talking about. So I wanted to clarify. Thanks for that.
Yeah. And it's a long-winded way. I'll get back to your question as far as setting expectations. But then the second part of that is really is the supply chain reconfiguration and reshoring, which obviously this is something that started during COVID and is starting to gain more traction now, which is companies realizing that they need a domestic, whether it's manufacturing or distribution, they need more of a presence on U.S. soil. Now, what most people don't realize, and I didn't realize till I got into the industrial space, is if a manufacturer decides to establish itself, have a U.S.-based presence, there's a multiplier effect. So let's say that there's a 1 million square foot manufacturing facility that decides to set up in a city. What usually ends up happening is there's an additional 2 to 3 million square feet. So 2 to 3 times a multiplier effect that happens of industrial space that's needed just to service that local manufacturer. And a great example of this really quick is we're getting ready to close on a property in Greenville, South Carolina. One of our tenants, their sole purpose is to deliver pallets to BMW. Their domestic manufacturing is based there. And so you see this happening at scale as there are local vendors that need to service those local manufacturing economies. So when we're setting expectations to start, it's what is the long-term tailwind for an industry? The second part then we look at is what are the supply demand fundamentals? So that's what we've already talked about. And then the third part is what are we able to purchase those assets for? What are the underlying fundamentals of a property? So all of those are important things that go into our investment decision framework and how we think about an investment over a 3 to 5 year period. Because to your point, we can't see into the future, but we can look at a lot of data across our own portfolio of 15 million square feet of industrial and commercial space, and also what the macro is telling us as far as what to expect over that time. So I hope that answers your question.
No, that helped a lot. I think if people can kind of distill that and understand that, just that part, maybe even rewatch that, re-listen to that, and use that as kind of their own thesis when they look at investments, I think that will serve a lot of people and probably would have kept a lot of people out of trouble in the last couple of years. But again, I think it's really interesting because I've seen, again, I think the industrial side, that part has been always fascinating to me. And seeing the growth of that, now also seeing, I mean, you've also helped clarify what some of the tailwinds are behind that. I think it's an interesting opportunity. And so how are people like typically investing in that space? I mean, I guess they can own themselves, which I've heard of, but I mean, are a lot of people investing in the space through, syndications or funds? Like what are people doing mostly?
Yeah, I mean, look, I think people can own property directly. So the thing about warehouses, they come in so many different shapes and sizes. So Peter, you alluded to the Amazon, or the Target or Walmart, these massive, half a mile wide distribution facilities that you see popping up all over the place. Those are obviously generally invested through, whether it's a publicly traded REIT or a private real estate investment fund or a syndication. So those are generally done on a passive basis through one of those, I would say, different investment vehicles. But then you have smaller warehouse facilities. You have, like, as an example, what we invest in at Lightstone is what's called shallow bay industrial real estate. So generally these are multi-tenant buildings. So anywhere from, let's call it 5 to 20 industrial bays that range between 20,000 and 100,000 square feet. And there are some of these that might be 2 units that are 10,000 square feet, right? And people might buy those directly. And again, the difference in the tenant base is where on the larger regional distribution facilities, you have the credit of Amazon or Target. And again, you pay for that. Those are usually very priced at a premium because of the risk that you're taking in owning Amazon, which is not much anyways. But then as you go a layer deep, as you keep going down to these smaller, shallow bay multi-tenant buildings that we own, these are generally properties with tenants that serve the local economy. Again, it can be an HVAC contractor. It can be tenants that serve local manufacturing. So they're going to be generally tenants you've never heard of. And for that reason, sometimes I think individual investors get a little hesitant about buying those types of properties directly for a couple of reasons. So, but let's just say you were to buy a 4-tenant building, a shallow bay building, and you had a bunch of tenants in there you never heard of. Well, if you don't have a good understanding of what that tenant does, what their financials are, and your ability to release that space, and let's say one of those tenants leaves, well, now up to 20-25% of your cash flow can erode just from that vacancy. And that's where Lightstone, where we really, I think, add a ton of value, is through our hands-on asset management approach. And again, we have a portfolio. One, we're generally only acquiring deals in markets that we already own in. It's what we call clustering. So if we're buying like as an example, we have 9 properties in over 2 million square feet in Harrisburg, Pennsylvania. And again, that helps with economies of scale, and it also helps with leasing as well. And one of the beauties of industrial real estate is it's a bit different than multifamily. In multifamily, if a tenant leaves, they generally give you 30 days notice, right? That they're going to leave. Well, in industrial, they generally have to give you 9 to 12 months. And so that gives us plenty of time. And usually even before we've acquired a property, we're doing a lot of upfront due diligence on our tenant base to understand how long have they been at the property. What is their likelihood to renew? What other options are in the market for them? So if they wanted to leave, where can they go? And back to that supply demand fundamental that we pay a lot of attention to, what's unique about shallow bay real estate is that, and especially Class B shallow bay real estate, remember I talked about all the development activity that's happened over the course of the past several years. Very little of that supply has come in the form of shallow bay real estate. And then there's no new Class B supply being built. So we want to be the low cost provider in a market in the shallow bay product. And so again, our tenants usually don't have a lot of options, and we're usually the low cost provider in the space. But again, if you're investing as an individual in these types of properties without the experience, that can be tough. People do it for sure. You just have to understand what those risks are, understand who your tenant is, making sure that you're doing tenant interviews and understanding what their financials are and how tied they are to that local economy.
Awesome. I mean, I think this whole space of industrial is really fascinating. We talk a lot about like apartment space, and I think people understand that. Industrial, people kind of get the whole concept. And I hope this has been helpful for people. I think we could spend even more time. I'm sure we'll bring you on to talk even more about the nuts and bolts of industrial and ultimately how to do the proper due diligence for this. I think that's been the goal of what our conversation is, to provide enough nuggets for people as they go out there and look for different real estate investments, to understand what are the things that they should be looking for, the questions they're asking, and how to set themselves up to ultimately make good decisions to hopefully create passive income for themselves and create other streams of income. You've talked to thousands of physician investors, I know, over time. Like, maybe you could let us know a little bit, like what's a common mistake that you see a lot of physicians make when they think about investing in real estate? And ultimately, I guess on the outside of that is like, yeah, so how can we avoid something like that? I think that's the whole goal. Is there a common mistake that you think a lot of physicians make when thinking about real estate or going into an investment, just from having your experience of talking to so many people?
I would say it's the biggest mistake I would say I've seen investors make, specifically physicians, is chasing cap rate. And what I mean by that is, or chasing yield to be more specific, is that especially right now, what's important for any investor to understand is there is generally no free lunch. So if there is a strong, very strong cash flow coming from something, there's usually a reason why. And you need to understand what those reasons are. So as an example, Class A multifamily real estate right now, it's very tough to generate yield right now because of how compressed cap rates are. Or
Explain yield or cap. I mean, in real quick, yield?
Yeah. So when a property generates cash flow, what a cap rate essentially is measuring is the less yield that you're getting from an investment is generally the more expensive the property. And the market is viewing that investment as less risky. So Class A multifamily real estate right now is viewed at very similar to like a credit quality bond, where right now you might only be able to get 4 to 5% in annual cash flow. Where as you invest in Class B or Class C assets, that yield increases, because as the yield increases, that is essentially a risk premium. So as you're earning more return, it is not without incremental risk or added risk. And so I remember a lot of my physician clients would come to me and say, hey, I'm looking at this deal, like your deal's only yielding 5 or 6%, but this is yielding 9. What's going on? And when you look at it and you look at the property, maybe it's in a very tertiary market, or there's aggressive underwriting assumptions, or the property is being purchased at very high leverage, which enables them to generate a much stronger yield. So you really have to understand why someone is able to generate that type of yield. Now, again, we like to play kind of in the middle. We focus mostly on, again, Class B product. But again, like where we have an advantage is that we have a 25,000 unit square foot or 25,000 unit multifamily portfolio of Class B assets, and a 15 million square foot of it Class B industrial investments, because what gets a lot of managers and investors into trouble is buying these older assets and not understanding how much it costs to truly manage an older asset, right? And that's where we have a really unique advantage. We're a vertically integrated company, and I hear a manager talk about this. It just means that they have in-house construction or property management expertise. And that, again, that allows us to be much more hands-on. So the biggest mistake I see people make is chasing higher yields without really understanding the additional risk that they're taking for a lot of the reasons I just mentioned.
That's great advice. So what excites you about what Lightstone is stepping into in the future? Like, what are you guys working on? What's in the future for you guys?
Yeah, I mean, right now, and like I said, we're really nose down, really in the process of really expanding our Class B shallow bay industrial portfolio for all the reasons I mentioned before about a lack of supply when it comes to shallow bay real estate more broadly, and then more specifically, affordable Class B space, functional space. That's what we are, our investment team is still actively pursuing, and we're actually under contract to acquire a shallow bay, a six tenant shallow bay industrial deal in Greenville, South Carolina. And it really fits. It's like the textbook example of what we look for in a kind of like a perfect shallow bay deal. So Greenville, South Carolina is actually one of the top most dynamic industrial hubs in the country. And again, not something I was fully aware of until we really started looking at this deal. But you have, BMW, it has their US-based domestic manufacturing there. That's where they produce the X3, the X5, the X7. Isuzu, actually, talking about the reshoring tailwind, Isuzu just announced they're going to open brand new 1 million square foot manufacturing facility in Greenville. And we are acquiring infill Class B multi-tenant shallow bay property. And it's very much a value add opportunity. So, and again, to expand a little bit on this, what we look for in a value add opportunity is when we have the ability to what's called mark rents to market. So all that means is we have an ability to raise the rent roll and increase our net operating income. And by doing, and the way that we're able to do that is by improving the property, right? And that improving the property, that is in the form of usually some capital improvements. So we're going to be replacing the roof. We're going to be improving some of the office space, fixing some of the dock doors. So there are things that we're doing to the property to help improve the physical characteristics of the building. And then we're going to be just slightly marking rents to market. And what's been really interesting is we haven't even closed yet. And we're already involved in conversations with some of these tenants that have reached out to us who are already looking to renew their lease. And again, it goes back to that concept of scarcity. We're in a very strong dynamic market, and there's not a lot of places for tenants to go. And our rent roll is about 20 to 30% below what comparable Class A shallow-based space looks like. And a lot of tenants, they just want functional warehouse space. They don't need necessarily all the bells and whistles and the power and a lot of the things that new Class A facilities provide. And again, so this is a deal that will be able to produce very strong cash flow day one and provide some upside once we've executed that value add business plan to investors. And so this will actually be the first deal that we're launching. We're bringing 2 outside investors as part of Lightstone Direct. We'll be launching that in the next 30 days. Then we've got a pipeline of opportunities that we'll be launching in 2026 as well.
And is there anything that you think that people need to know about Lightstone that makes you guys unique in the marketplace today? Just curious.
Yeah, no, thanks for asking that. And what really makes Lightstone unique, going back to what I mentioned earlier, over our 40-year history, most of the deals that we've done have been using our own capital. And that's what we will be bringing, that same ethos to Lightstone Direct. So we will be investing a minimum of 20% in every deal we do. So if you look at really, most managers are investing anywhere between 0 and 5% of the total equity required in each deal. We'll be putting about 4 to 5 times that in every single deal that we do. And so again, that just shows the level of conviction that we have in the deals that we're bringing to investors.
Awesome. Sounds like you guys are going to be busy. So
yeah,
that's awesome. I know some people are going to hear this. They're going to connect with you guys, hear a little bit more about you. Where's a great place for people to do that?
For starters, you can email me, jspitz@lightstonedirect.com. You can go to our website, lightstonedirect.com. At the moment, we have a landing page right there. If you provide your name and email, we'll stay in contact with you and provide you more information, including the deal I just referenced as soon as it becomes available here in a couple of weeks.
Awesome. Well, I want to thank you for your time. I mean, again, you did an amazing job kind of wrapping up the market so people understand where we're at today. I think people probably learned a lot about industrial and understand what to look for in some of these deals. And of course, just overall due diligence on deals and understanding risk and return. I thought you did an amazing job of that. And so I know people got a ton out of this. So I appreciate your time. Thanks for this. And I'm sure I'm going to be talking again soon.
Yeah, absolutely, Peter. Thanks again for having me on.
All right. Bye.
Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.